Assalamualaikum. Today we are going to learn another MFRS, which is MFRS 138, which talks about intangible assets. So following previous classes, so what I'm going to do today is to provide the definition of MFRS 138, followed by the recognition of this item. Then we will go to initial measurement, and subsequently I'm going to explain on subsequent measurement. Okay, so this is what we're going to learn today, right? So we will start with the definition of MFRS 138. So under MFRS 138, they have identified intangible asset as identifiable non-monetary asset without physical substance. Now this type of asset is different from tangible asset, in the sense that if you look back, if you can still recall what we have learned during MFRS 116, we can actually see the physical substance of that particular asset, right? For example, plant, property, right? Machinery, building. So all those we can see its physical form. But we also have asset that we cannot see its physical form, right? For example, patents, copyrights. We know that it's there, but we cannot see how it looks like. Okay, so this intangible asset under MFRS 138 exclude goodwill because it is inseparable, and it is going to be covered under MFRS 3 under goodwill on consolidation. Okay, so we look at what is the extension of the definition of intangible asset. One, it is identifiable, meaning that it arises from contractual or other legal rights separately from goodwill and any other assets. Alright, so when you have made a transactions and the transaction, the cost or the amount that you're going to get exceeded the cost of that particular item, then the difference normally represent the intangible asset. So we can say that intangible as that one particular item is intangible if we cannot see its physical substance, and it is identifiable, and it is separable, meaning that we can actually sell it to an outsider, right? For example, if we have an intangible asset, let's say patents, so we can actually sell the patents to an outsider, right? So if let's say we have produced a product and we have patented it in the with the regulatory bodies, right? We can actually explain. We can actually identify that particular asset as ours. So if we want to sell it to another party, then we can sell it, right? So it can be sold, rented, or exchanged separately or individually. Okay. Now intangible asset should also be controlled by the entity that owns it, right? Meaning that they have the power to obtain benefit from the asset and power to prevent the access of others to those benefit. Okay, so if you have an intangible asset, if you can get income from that particular asset, then you can actually prevent other parties to get access of the benefit of that particular asset, then that asset is said to be controlled by the entity. And lastly, intangible assets should also should also evidence the existence of future economic benefit, right? This include revenue from sale of products or services, cost saving, or other benefits. So intangible asset should meet all these requirements, right? That is identifiable, controlled by entity, and also the existence of future economic benefit. So to further understand about what intangible asset is, let's look at the illustration. So if you look at illustration number 1, an entity that owns a brand name that it purchased from a competitor, the brand name is legally protected through registration with the local government of a trademark. So they asked us to explain the classification of the brand name. So we can see that the brand name is a trademark, and therefore is an intangible asset of the entity. It is an asset of the entity controlled, evidenced by the legal right, and the entity would have purchased the brand name with the expectation that it would increase the future revenues, either by selling products or by preventing its competitors from selling products. So it meets the criteria of an intangible asset because, if you can still recall, it arises from contractual or legal rights, right? It is separable because we have actually purchased the patent from another party, and we believe that it provides existence of future economic benefit. Okay. And they further explain that the brand name is an intangible asset. It is non-monetary, that is neither currency held nor an asset receivable in a fixed or determinable amount of money, without physical substance because it is a legal right, identifiable because it is evidenced by legal protection through registration, and can be sold separately. So the entity applies the recognition criteria of paragraph 21 for determining whether to recognize its brand name intangible asset. Okay. So under paragraph 21 of MFRS 138 states that an intangible asset shall be recognized if it is expected that future economic benefits that are attributable to the asset will flow to the entity, and the cost can be reliably measured. So we look at illustration number 2. Because of its effort in building customer relationships and loyalty, that is through advertising, an entity expects that the customers will continue to trade with the entity. Example, a fast food outlet. There are no contracts with those customers. The entity estimates cost to develop the customer's list amounting to 50,000 and intend to capitalize the customer's list as intangible asset with indefinite useful life. Okay. So explain the classification of the customer's list. So we know that an intangible asset is an identifiable non-monetary asset without physical substance. And what does it mean by identifiable? That is, it is separable, that is capable of being separated or divided from the entity and sold, transferred, that is licensed, rented or exchanged either individually or together with a related contract, identifiable asset or liability, regardless whether the entity intends to do so, or arises from contractual or other legal rights, regardless whether those rights are transferable or separable from the entity or from other rights and obligation. Okay, so what does it mean by legal rights? That is, they provide the entity with a capacity to control the future economic benefits from an intangible asset, meaning that an entity will control an asset if the entity has power to obtain future economic benefits flowing from the underlying resource and restricting others to get access of those benefits. So in the absence of legal rights, it is more difficult to demonstrate control. However, legal enforceability of a right is not necessary. A condition for control, because an entity may be able to control the future economic benefits in some other ways. So in this case, we find that there is an absence of legal rights to protect the entity's relationship with its customers or to control the customer's loyalty to the entity. So we can say that this entity usually has insufficient control over the expected economic benefits from its customer relationship and loyalty for such items. For example, a list of customers, market share, customers' relationship, and customer loyalty. So we cannot say, because of the absence of control and legal rights, we cannot say that the company has the customers' list shall not be recognized as an intangible asset. Okay, so in addition, paragraph 63 of MFRS 138 says that internally generated brands, mastheads, publishing titles, customers' lists, and items similar to in substance cannot be distinguished or cannot be separable, shall not be recognized as intangible assets. So paragraph 64 of MFRS 138 also mentioned that those related to expenditure on internally generated brands must have customers list and items similar in substance which cannot be separable or cannot be distinguished from the cost of developing the business as a whole. So these items shall also not be recognized as intangible asset. So therefore, we can say that the internally generated customers list shall not be recognized, but separately acquired customers list may qualify for recognition if it meets the definition criteria. Right? So we can say that from the case above, the company has actually built the customers relationship and come up with the customers list and from the business itself. So it is considered an internally generated. So we cannot identify this customers list as intangible assets. Okay, unless if they have mentioned that the customers list is can be separable from the company, then we can say that it is an intangible asset. Next, we go to the recognition criteria. Now, the basic rules of recognizing whether an asset is an intangible asset or not is, first, it must meet the definition of intangible asset. So if you look back what the meaning of intangible asset, that is identifiable non-monetary asset without physical substance. Okay, and then there is a probable future economic benefit that will flow into the business. Okay, and the cost can be measured reliably. Okay, so what about goodwill? Alright, so goodwill, it depends on the situation whether it is internally generated or acquired through acquisition. So if it's internally generated goodwill, then this asset should not be recognized as intangible asset. Right? Why? Because first, it is not separable. Right? Without selling the company, we cannot exactly determine what would be the amount of goodwill. Okay? No reliable or predictable relationship to any cost incurred. It arises from intangible factors within the entity such as strategic location, skilled workers, which have subjective value. Right? For example, if we have the same type of business, two companies with the same type of business, for example, companies A probably located in the city of Kuala Lumpur, and then the other one is located outside Kuala Lumpur, with the same type of capital injected to the company, we find that when we want to sell back the company to another party, the company that is located in the city of Kuala Lumpur would likely have higher value than the one outside Kuala Lumpur. So we can say that the difference would likely be goodwill. Okay. However, if it's arise through acquisition, then this goodwill would be considered as intangible asset. Now, this falls under MFRS 3, where it involves a parent-subsidiary relationship. So the moment the parent acquire the subsidiary, they have to determine the goodwill or bargain purchase acquired from the purchase of the company, the interest in the company. Right? For example, let's say that the company, the parent company, paid 100,000 to acquire the subsidiary, okay, to acquire 100% interest in the subsidiary, and when they've compared the price that they pay to acquire the subsidiary, they realize that the net asset of the subsidiary is only 80,000. So the 20,000 is actually the goodwill. Alright, so this type of goodwill would be considered as intangible asset. Okay. Now what about research? Okay. So if you look at the definition of research, that is planned investigation with prospect of gaining new things. So the reason why we do research is because we probably want to find new findings. So we want to come up with products. Alright, so research does not fall under intangible asset and should be written off as expenses when it is incurred. Alright, so why do we not classify this an intangible asset is because of the uncertainty to obtain the inflow of benefits. Right? Sometimes when we do research, we come up with an outcome. Okay, let's say we manage to come up with a product, but we are not certain whether we're going to get benefits or from the product. We may have that product, but then it is not sellable. Right? So that's why research cannot fall under intangible asset, but we have to write it off as expense. For development, okay. Now, development normally arises from the findings of the research. So if let's say in research we manage to come up with a product, all right, and under development, they are going to continue from where the research stopped, that is to continue developing the product. So under it is more of application of research findings. Now, for development, we can only recognize it as an intangible asset if it satisfies all 6 criteria, right? That is, probable economic benefit will flow, intention to complete for use or sell the asset, okay. Resources, that is financially and technical, is adequate to complete, ability to use or sell the asset, and technically feasible to complete and use the asset, and the expenses can be reliably measured. So if you have developed something, developed a product, and you are sure that the development cost, the product will satisfy all these 6 criteria, then only you can recognize that product as an intangible asset. Otherwise, we have to recognize, following research, recognize it as an expense. Okay, so we have to fulfill all these product before we can charge that particular product as intangible asset. For other internally generated intangible asset that falls under para 65 of MFRS 138. Now we will only recognize an intangible asset or as an intangible asset if it meets the definition and recognition criteria as been discussed just now. And the cost will include all directly attributed costs, for example, material, employees, to register the legal rights. So all those costs directly attributable to that intangible asset, then we can recognize that as intangible asset. However, if it fails to meet the definition and recognition criteria, then that item should not be classified as an intangible asset. So where shall we charge it? We shall charge it to the income statement as an expense. Okay, for example, startup costs, training, business relocation. So all these are not considered as intangible asset. Okay, so we look at one illustration that can further enhance our understanding. Research and development costs. An entity developed a successful brand that allows the entity to charge a premium for its products. The entity continues to spend large amount on maintaining the brand and on developing the brand further. That is sponsoring the local sports events, sponsoring select cultural events, and advertising the brand. So the assets to explain the entity on the recognition of the brand. So in this case, the costs incurred in developing the brand do not satisfy the recognition. Okay? The expenditure incurred for sponsorship and advertising are not recognized as an intangible asset. They cannot be distinguished from costs incurred in respect of developing the business as a whole. So this costs should be recognized as an expense as they are incurred. So if you can go back and recall, if you want to understand further on what does it mean by explanation on the development cost, whether it should be recognized as an expense or not, you can refer to paragraph 29 of MFRS 138, where they provide examples of expenditure that are not part of the cost of intangible asset, and this includes introducing a new product or services, such as cost of advertising and promotional activities. So these two activities, the cost incurred in advertisement and promotional activities should not be classified as an intangible asset. Okay, we proceeded to illustration number 4. An entity acquired two trade secrets, that is secret recipes, in a business combination. Receipt A is patented, receipt B is not legally protected. So explain the recognition for the two trade secrets. So you can see here, receipt A is patented but not receipt B. So receipt A meets the contractual legal criterion for identification as an intangible asset because it is protected by the patent. So this receipt is recognized separately from goodwill in the accounting for the business combination unless its fair value cannot be measured reliably, because either it is not separable from goodwill or it is separable from goodwill but there is no history or evidence of exchange transaction for the same or similar assets. Okay, but for if you look at receipt B is also an intangible asset because it is separable from other assets. That is, it can be exchanged, licensed, or leased to others in its entirety or in part, and the future economic to be generated from there. In such cases, the unpatented receipt would be accounted for as a separate intangible asset acquired in the business combination. Okay, so regardless whether it is patented or not patented, if it is separable from the business, then we can say that it is an intangible asset. Right? So we have completed the definition and the recognition of intangible asset. So now we're going to proceed with how do we measure the intangible asset. So under measurement, you need to understand first the initial measurement. Then after that, well, you need to understand how do we measure intangible asset from year 2 onwards. Okay. Now, it depends on the situation whether you acquired, it is a separate acquisition, or acquisition as part of the business combination, or acquisition by way of government grant, or you can also have an exchange of asset, and lastly, internally generated intangible asset. So under separate acquisition, the cost can be measured reliably. Alright, so to measure at cost, the amount of cost that we need to include is the purchase price plus any directly attributable cost. Right? However, cost that is associated with introducing the asset or new location or administration and overhead costs, now this cost should not be included in the cost of the intangible asset. So it should not be capitalized. Okay? So we look at one illustration. On 1st January 2001, an entity purchased a new software package to operate its production equipment for 600,000. The company paid 10% non-refundable deposit on 1st January 2001. The balance of the purchase price was funded by incurring a loan, and the loan is secured against the software license. In January 2001, the entity incurred the following costs in customizing the software so that it is more suited to the system used by the entity. So the incur cost of labor for software installation and modification, 120,000. In February 2001, the entity production team tested the software, and the information technology team made further modification necessary to get the new software to function as intended by management. The following costs were incurred in the testing phase. That is materials 21,000, cash receipt from sale of the scrap output 3,000 and labor 11,000, and the new software was ready for use on 1st January 2001. And then in March 2001, they incurred the following costs: training costs to train the staff on how to operate the new software, which include cost of an expert external instructor 7,000 and labor 3,000, and also they incur a loss of 23,000 on operating the software during March due to low initial order levels. Okay, so they ask us to determine the cost of the software at initial recognition. Okay, we know that the purchase price is 600,000. Okay, preparation cost, that is the labor cost, 120,000. And then we have cost of testing 21,000, that is net of the 3,000 recovered from the sale of the scrap output plus 11,000 labor. So the total cost of testing is 29,000, resulting in the total cost of the software as 749,000. Okay. Now the cost that we incur in March, which is related to training costs, and loss incurred in March will be recognized as an expense in the profit and loss account because the software is capable of operating in the manner intended by management without incurring the training cost. So that cost is considered not necessary. So that cost will be treated as an expense charged to the profit and loss. Now that is an illustration that relates to separate acquisition. Now if it's an acquisition as part of the business combination, alright, so this one is when we recognize the fair value of the intangible asset of acquiree, and it is separable from goodwill. Alright, so the fair value of the intangible asset will be the quoted market price or the price of the most recent similar transaction. Do bear in mind that we can only recognize an intangible asset if it's separable from goodwill. Alright, so let's look at illustration number 6. On 1st January X1, an entity acquired all of the issued shares of a competitor, that is the acquiree. When the acquiree's intangible assets were, they have provided us the carrying value and fair value of the customer list, in process research and development project, the license to operate, and brand, including trademark and brand name. And then in 2001, the acquirer incurred 200,000 in additional expenditure to complete the research in progress project and subsequently decides to develop the related product commercially. Okay, determine the intangible asset of the group. Right, to determine, because this is related to business combination. Okay, on 1st January 2001, when the acquirer acquired the acquiree, then the acquirer and the acquiree will be viewed as a single entity, as a group. And when they record the intangible asset, it should include those intangible asset that is separable from goodwill. So here we can see that customers list, in process research and development project, license to operate, and the brand all are related to intangible asset. So this should be recognized at the time when they acquire the acquiree. Although the acquired in-process research and development is recognized as intangible asset because it was acquired in the business combination, then because of the business combination, we have to treat this research and development cost as intangible asset. Subsequently, the subsequent expenditure of 200,000 will be treated the same way as expenditure to create an internally generated intangible asset. So in this case, we should not recognize the 200,000 as an intangible asset, but we should recognize it as an expense as and when it is incurred. Now we go to the next one, that is acquisition by way of government grant. That is, we obtain landing right, right to service ferry court road. So these are examples of acquisition by way of government grant. So in this case, how do we measure the intangible asset? We will measure at its fair value plus any attributable expenses. Alright, so we look at example number 7. On 1st January 2001, a local government issued 3 identical licenses to broadcast in a particular city for a 10-year period. So 2 licenses were sold by public auction to independent third parties from outside the local community. In an attempt to develop local ownership, the third license was given to a local entity free of charge. So each fair value of each of the broadcasting license is 100,000. The grant does not impose specified future performance conditions. So the initial recognition of the third license, if we base on the MFRS 120 government grant, the local entity that received the third broadcasting license shall measure the license, that is the intangible asset acquired by way of government grant, at 100,000, which is its fair value, on initial recognition, and recognize the grant of 100,000 as an income. So we will recognize the item. So we'll debit intangible asset and credit statement of profit and loss of 100,000. So we proceed to the next one. That is when we have exchange of asset. So when we have exchange on asset, the value that we should include is the fair value of the asset acquired, or the fair value of asset given up, or the carrying value of asset given up. So which value should we take first? So we'll first follow or based on the fair value of asset acquired. So if let's say we cannot determine the fair value of the asset acquired, then we base on the fair value of asset given up. And if we can't determine the fair value of the asset given up, then we have to rely on the carrying value of asset given up. So if you look at illustration number 8, on 1st January 2001, an entity received landing rights at a local airport in exchange for 90,000 litres of aviation fuel and 10,000 cash. Aviation fuel costs 1 ringgit per litre. So they ask us to determine the initial recognition of the landing rights. Now the landing rights received, that is the intangible asset acquired in the exchange transaction, must be measured at the fair value on the initial recognition, which is 100,000. So the fair value of the landing rights is determined by reference to the fair value of the aviation fuel, that is 90,000, plus the fuel of 90,000 litre, that is 90,000 litre times 1 ringgit per litre, plus the 10,000 cash given up in the exchange transaction. So the total value is 100,000. That is the fair value of the asset given up. Because they did not mention, if you recall back the notes, so it should be based on the fair value of asset acquired. However, in the illustration, there is no information on the amount of the fair value of the asset acquired. So we base on the fair value of asset given up, right? So the fair value of asset given up, they've mentioned here, 90,000 litre of aviation fuel of 1 ringgit each per litre, plus 10,000 cash. Now, the last type of asset for initial measurement is internally generated intangible asset. Now this one, we can only recognize an internally generated intangible asset if it meets the recognition criteria of the development cost, that is the 6 criteria. Okay, if you can still recall, we must make sure that that asset can only be recognized as intangible asset if its probable economic benefit will flow, intention to complete for use or sell the asset, resources is adequate to complete, ability to use and sell the asset, technically feasible to complete and use of the asset, and the expenses can be reliably measured. So only then we can recognize that cost as intangible asset. Now why? Because it is not identifiable. So internally generated goodwill is prohibited. Okay. So internally generated goodwill is prohibited mainly because it is not identifiable. Right? For example, if we have a company and if we want to know the goodwill without selling our company, we would not be able to identify how much would be the goodwill. All right. So we can only identify the goodwill in our company if we decided to sell it. How much is the other party willing to pay in order to get our company compared with the net asset of our company? When the amount paid to acquire a company is more than the net asset, the value of the net asset of our company, then that gives rise to goodwill. Okay. Now, if let's say we have decided that okay, now we have met the 6 criteria of the development cost. Now, but previously we also have incurred the development cost. So what we can do is we can only identify the cost as intangible asset from this year onwards. So those costs that have been expensed off, that type of cost cannot be reinstated as intangible asset. Okay, let's look at illustration number 9. An entity has established a substantial list of customers. Internally, over time, the list is considered to be valuable to the entity. The entity estimates cost incurred was 30,000. On 1st January 2001, the entity acquired a customer's list from another entity for 100,000, where we can actually know the value. This is not internally generated. The management could sell the externally acquired customer list to third parties. In 2001, the entity estimates that it incurred a further 15,000 staff costs in maintaining and developing this externally acquired customer list. Right? So determine the initial recognition of internally and externally customers list. Now we know that if it's internally generated, we cannot recognize that customer list as an intangible asset. Why? Because MFRS 138 specifically prohibits an entity from recognizing internally generated intangible asset. So the cost of establishing the list cannot be distinguished from the cost of developing the business as a whole. However, for externally generated lists and additional costs incurred, the externally acquired customer list must be measured at 100,000 on initial recognition because it meets the recognition criteria. So note that the list meets the definition of intangible asset because it is separable. So how do we know whether it is separable or not? Meaning that we can sold it to the third party. However, the cost of 15,000 incurred in maintaining and developing the external acquired customers list, this one we need to recognize it as an expense in the determination of profit or loss for the year. The subsequent expenditure on customers list, whether externally acquired or internally generated, is always recognized in the profit and loss as incurred. This is because such expenditure cannot be distinguished from expenditure to develop the business as a whole, and hence does not satisfy the recognition criteria of an intangible asset. Okay, so we are done with initial measurement. So there are 5 types of cost or item that we that we need to understand. Okay, so we need to understand the difference or how we recognize initially, depending on the situation of the acquisition. Okay, so if we have acquired through separate acquisition, the treatment is not the same as when we acquired it through business combination and so on. Alright, so this is the initial measurement. Now we look at the subsequent measurement, that is from second year onwards. So subsequent measurement is similar to MFRS 116. That is, the standards actually allow companies to either value the intangible asset using the cost model or using the revaluation model. If we have used the cost model, then the total cost that should be included would be the cost that we have incurred minus accumulated amortization if it has finite life. Okay, if it doesn't have if it's in the indefinite life, meaning that we would not have amortization, right? So we can only amortize if they have an infinite life. Okay, and then minus accumulated impairment loss, right? So we look at one illustration. On 1st January 2001, an entity acquired a franchise license for 500,000, and the management measured the amortization of the license at 100,000 per year. As at 31st December 2003, in response to the entry into the market of a competing franchisor, the entity assessed the recoverable amount of the franchise license at 180,000, and they asked us to determine the carrying value of the franchise license on 31st December 2003, and also prepare the extracted statement of financial position of that on that date. Alright, so to determine the cost of the franchise license, so we have the franchise license cost of 500,000, and they mentioned that the franchise license have an amortization cost of 100,000 per year. So from 1st January 2001 up to 31st December 2003, the total amortization on the franchise license would have been 300,000. So that resulting in the carrying amount of 200,000. And to see whether we have impairment loss or not, we compare the carrying value and the recoverable amount. If the recoverable amount is higher than the carrying amount, then there is no impairment loss. However, if the recoverable amount is lower than the carrying value, then that resulted in impairment loss. Right? So they mentioned here that the recoverable amount is 180,000. So we compare with the carrying value of 200,000. So we have impairment loss of 20,000. So we recognize this 20,000 to the statement of profit and loss. So we debit impairment loss 20,000 and later close it and charge it to the statement of profit and loss, and then credit your accumulated impairment loss 20,000. So at the end of the year, 31st December 2003, the carrying value would have been the cost of franchise fees 500,000 minus with accumulated amortization 300,000, which is 100,000 times 3 years, and then minus your accumulated impairment 20,000. So the total carrying value after impairment is 180,000. Next, we continue with the next model. Now the standards also allow companies to adopt revaluation model, which is similar to MFRS 116, right? So under revaluation model, the amount that we should carry in the accounts of intangible asset, that is, it should be carried at revalued amount, being its current fair value, right? So then the fair value minus subsequent accumulated amortization and impairment loss. Okay. Now, however, we cannot simply use revaluation model. It has to meet certain condition. First, the existence of fair value is based on the active market. So if you have an asset, intangible asset, that cannot be determined in the active market, then we are not allowed to use revaluation model. So we have to use cost model. And if we have decided to employ the revaluation model, all the entire class of the intangible asset must be revalued as well. Okay. So if there is no active market available, then we have to use the cost model. Okay. Now, when we use revaluation model, that will give rise to as whether we have surplus or deficit on revaluation. If you have surplus, then you have to credit your ARR account. Alright, meaning that you debit your intangible asset and you credit your ARR account. And the surplus will be recognized as income for the deficit of the same asset which was previously recognized as an expense. So then the ARR will be transferred to the retained earnings when the intangible asset is amortized or disposed. However, if we obtain deficit, then the difference of the deficit will be charged to the income statement. So we will debit ARR if we previously have a ARR account, that is, we have an ARR on the credit side. So if let's say we have deficit, then we will debit ARR. Okay. The maximum amount that we can debit our ARR is equals to the credit side of the ARR. If let's say that the amount exceeded the amount that is available in the credit side of the ARR, then what we can do is we will charge the full max amount of the revaluation in ARR account to the equals to the amount available in the credit of ARR, and the difference will be transferred to the income statement. Right? For example, let's say assuming that this is your ARR account, okay, and currently you have a balance brought down from previous revaluation of your intangible asset, so example 10,000, and then when you revalue this year, you have a debit balance, right, which arises from your intangible asset account. So you have a deficit, let's say for example let's say you have a deficit of RM 12,000, okay, and your ARR account currently has a credit balance of 10,000. So if you have a deficit of 12,000, the amount of 12,000 exceeded the amount available in the revaluation reserve. So what you do is you charge debit ARR account the maximum of 10,000, and the difference of 2,000 will be charged to the income statement. So it will be like this: deficit, intangible asset, 2,000. Right? So you cannot actually debit your ARR the whole 12,000 because the amount available in the credit balance of ARR is only 10,000. Right? So if you have the amount of deficit is more than the amount available, so the difference should be charged to the income statement. Okay. Now we go to the next part, that is amortization. Alright, so amortization depends whether the intangible asset has a definite life or indefinite life. If it's indefinite life, as you can see here, the intangible asset should not be amortized because it is difficult for us to determine how long would the intangible asset will be with us. So the difficulty of determining the amortization amount requires us not to amortize the intangible asset. However, what we do is the useful life must be reviewed annually. Useful life must be reviewed annually, and if there are any changes, then we follow MFRS 108, that is changes in accounting estimates. So this one, for indefinite useful life intangible asset, it is required to annually test for impairment loss. For definite life, right, meaning that we can actually determine the useful life of the intangible asset. So what we're going to do is we are going to amortize over the useful life. Okay, so let's say that if the intangible asset can be used for 10 years, so we are going to amortize over the 10 years. So if the cost of the intangible asset is 100,000, so we will divide by 10 years. So every year we will amortize 10,000 ringgit. So we will start amortize when the intangible asset is available for use, and the amortization amount should be charged to the statement of profit and loss. However, if let's say the intangible asset is held for sale, then we have to de-recognize that intangible asset. Okay. So how do we amortize the intangible asset? Now we are given the choice that we use a method that will reflect the pattern in which the asset future economic benefits are consumed, such as we can either use the straight line method or the reducing balance method. If the residual value is 0, unless the third party is committed to buy the intangible asset, or there is an active market available for the intangible asset and the price can be measured reliably. Okay. Now, once we have start amortizing the intangible asset, the amortization period and the method should be reviewed at every year end. And if there's any changes on the estimation, then we have to follow MFRS 108. Okay. Now, to further enhance our understanding, we have two cases that we can review. So we look at case study number 1. On 1st January 2004, Luyang Berhad acquired a trademark for a line of products in a separate acquisition from a competitor for 300,000, and Luyang expected to continue marketing the line of products using the trademark indefinitely. Okay, and analysis shows that the product life cycle studies market competitive and environmental trends, and brand extension opportunities provide evidence that the line of trademark products may generate net cash inflows for the acquiring entity for an indefinite period. Initially, the management estimates that the useful life of the trademark was 10 years and amortizes the cost of the trademark over the period, that is the presumed useful life, using the straight line method. However, on 31st December 2005, a competitor unexpectedly revealed a technological breakthrough that is expected to result in a product that, when launched by the end competitor, will reduce the demand for Luyang Berhad's patented product line. Because of the situation, Luyang expects the demand for its patented product line is to remain until December 2008. Hence, the company has reassessed the useful life of the trademark and estimated that it will last until the end of 2008. Luyang Berhad had continued manufacturing the patented products until 31st December 2008, and Luyang has a 31st December financial year end. And they asked us to prepare the extracted statement of profit and loss for year ended 31st December 2004, 2005 up to 2008, and statement of financial position on the respective year end. Okay. If you can see this, the useful life of the intangible asset is 10 years. So they asked us to show for 31st December 2004, 31st December 2005, 2006, 2007, and 2008. Alright, so the cost of the intangible asset is 300,000, and every year we are going to amortize the asset. Okay, 300,000, and the useful life is 10 years. So we amortize the asset. So 300,000 divided by 10 years. So first year, the yearly amortization is 30,000, and the same year, the second year, the amortization cost is also 30,000, and accumulated amortization becomes 30,000. So 30,000 last year plus 30,000 this year. So the total amortization is 60,000. So that leads to your carrying value of 240,000. Okay. When we go to the third year, that is in 2008, we find that at the end of 2005, that the demand for Luyang Berhad's will reduce, and therefore they have to reassess the useful life of the trademark, and it is estimated that it will last at year of 2008, that is another 3 years. Alright, and because of the reassessment of the trademark, then the amortization increased to 80,000. Okay, 80,000 is the yearly amortization, less accumulated amortization brought down 60,000, so you have 160,000 carrying value. Okay, so how do we get this 80,000? Is the carrying value at 31st December X5 is 240,000, and we know that when they reassess the patent, the trademark, the useful life remaining is 3 years. So 240,000 divided by 3 years, so you get a yearly amortization of 80,000. So the carrying value remain is 160,000 at 31st December 2006. So when we go to 31st December X7, so 300,000 is the cost, less for the 2007 amortization is 80,000, less The accumulated amortization brought down, that is 80,000 plus 60,000, so you get 140,000. So remaining 80,000. So when you go to the last year of 2008, the yearly amortization is 80,000. The total accumulated amortization is 80,000 plus 140,000, so you get 220,000. So 300,000 less 300,000, so the carrying value at the end of the useful life is 0. So in your statement of profit and loss account, you will charge the amortization expense for 2004, 30,000, 2005, 30,000, 2006, 2007, and 2008, 80,000 respectively. Okay. So yearly amortization has increased from 30,000 in 2004 and 2005 to 80,000 per year in year 2006 to 2008 due to changes in estimates of the trademark's useful life from 10 years initially to only remaining 3 years in 2006. Okay. So this is how they calculate the amortization expense for that particular year. So 2004 and 2005, the amortization is 30,000, and from 2006 to 2008, the amortization expenses is 80,000 per year. Okay, let's proceed to case number 2. So under case number 2, MyV incurred the following expenditures in establishing its taxi business in local city. So on 1st May 2001, they have started up the business. So the startup cost is 1,500. And then 30th June 2000 X1, the cost that they incur for legal costs directly attributable to the acquisition of the taxi licenses is 7,000. And then 30th June X1 also, they make payment to the taxi licensing authority for the taxi licenses and paid 100,000. And then on 1st July 2001, they incur costs on printing business cards of the drivers. So they incur 100 ringgit. And then on 1st July 2000 X1, they make payment for an advertisement to be published every day for the next 18 months in a local daily newspaper. So they paid 24,000 for that. So as at 30th June 2001, MyV made the following assessment. They have estimated that the useful life of the taxi license is 5 years from the date of acquisition. There's no residual value of the taxi license, and the entity expect to consume the taxi license's future economic benefits evenly over 5 years from the date of acquisition. Okay. The taxi drivers own their vehicles which they operate under MyV Berhad's taxi licenses. So they ask us to prepare the accounting entries to record the information set out above in the accounting records of MyV Berhad for the year ended 30th June X2, and prepare the statement of profit and loss and also the statement of financial position on 30th June 2002. Okay, so the startup cost, they ask us to do the journal entry. The startup cost will debit 1,500 because it's an expense, and we will credit our bank because the asset has reduced. So we charge to expense pre-operating cost. And then legal fees will be treated as intangible asset. So we will charge as intangible asset, debit and credit bank. And then on similarly, on the cost that is directly attributable to intangible asset, we will charge to intangible asset 100,000 and credit bank. And they have incurred printing cards for the drivers and prepaid advertising expenses. So we'll debit stationery expenses 100 and prepaid advertising expenses 24,000, and we credit bank 24,100. Okay, and finally at year end we will amortize the cost. So debit amortized expense 21,400 and credit accumulated amortization 21,400. So how do we get this 21,400? Is by 107,000, that is the cost of the intangible asset, which derived from intangible asset for the legal fees, as well as the cost directly attributable to intangible asset. So 7,000 plus 100,000, so you get 107,000. So divided by 5. In the profit and loss account, and then we have advertising expense as well. So debit advertising expense 16,000 and credit prepaid advertising expenses 16,000. So how do we get this? 16,000 is 24,000 divided by 18 months times 12 months. Okay. Now in the profit and loss, we will include all those items that is not capitalized as intangible asset. So such as the startup costs, stationery, amortization expenses, and advertising expenses 16,000. Okay. And in the statement of financial position, as at 30th June 2002, we have under non-current asset, we have intangible asset at cost 107,000. That is from the legal fees plus the cost directly attributable to intangible asset, less accumulated amortization 21,400. So you get 85,600. Right? And then you have prepaid advertising expenses 8,000. Okay. So basically we have done completed MFRS 138 intangible asset. So if we can still recall back what we have learned, we have done the definition of MFRS 138. What does it mean by intangible asset? And then we have also learned on how to recognize whether that asset is an intangible asset, followed by recognizing or measuring the intangible asset initially, and then subsequent measurement. So that's all for MFRS 138. So till we meet again for the next MFRS. Assalamualaikum.